everybody. This week's episode of Get Real with ECAR features Greg Antipoff, one of our affiliates, and a CPA. Greg, we're going to talk with you about anything taxes, anything related to COVID, stimulus packages, which I know things are in limbo, but whatever you got, let's talk. And anyone feel free to please ask Greg questions, whether it's about their business, the stimulus, anything you want.
Thank you, Susie, for having me in ECAR. I see our president, Greg Hanner, is on with us as well.
Hey,
welcome. Thank you for having me again. So yeah, as Susie alluded to, I was hoping to honestly have more of a hard fact update right now, but there's a lot of things that are up in the air, and we can kind of discuss that. And again, if anybody on the call has anything related to what I'm discussing or anything else in general, we do have the tax deadline for anybody who filed an extension, which is next Thursday. I believe it's the 15th. I've lost track of the days, but believe it or not, I still have agents coming to me doing their stuff for last year. And that's actually for a number of reasons. Actually, I'll touch on that for a second. This year started out in this industry really thinking that most of you were going to be in trouble. And for a lot of agents, it actually ended up being quite the opposite. So some people sort of in the depression of as COVID set in said, hey, I don't have the money to pay my taxes now. I usually wait till that spring market and I get those closing checks, and that's kind of when I pay for my taxes. And I'm just going to kind of push it off, and I'll have some time to gather everything, you know, in the summer and all this other stuff. And now they're realizing, you know, the market was much different than that. And now a lot of people are scrambling now at the last minute because they didn't have that time. So anyway, so next Thursday, if you haven't filed yet, that is the absolute deadline if you were on extension. So that's what we have coming up. And then as we head into the end of year, typically in November is when I'm sort of working with my clients to do tax planning, which is where, hey, how did the year go? Is there any last minute adjustments we need to do, tax strategies to get in place for this year before that strike of midnight on December 31st? And then likewise, are there some strategies that we're going to do for 2021 that we have to lay the groundwork for now? Example, if somebody's thinking about doing something with an LLC or an S Corp, we need to have that entity in place before January to get maximum effect. So that's kind of where we are on the timeline and typically are. Now, this year's a little bit different. PPP loan forgiveness is a big topic that my email inbox is blowing up with right now. I've been kind of pushing my clients off in the sense that there's a lot of talk from Congress that they were intending that to pass something where if somebody had a loan that was under $150,000, that rather than there being this whole application process to have it forgiven, there was just going to sort of be this blanket forgiveness. And that was being tossed around as part of, I've lost track now, I think the 4th or 5th coronavirus stimulus package that they were trying to pass. But then again, there's some things that have kind of gotten in our way now with the passing of the Supreme Court justice. Sort of the politics around that is going to occupy the Congress, you know, with the president of both the election and him contracting COVID. There's just a lot of things in the air that Congress isn't moving on any of this stuff. So what I've been telling my clients, because they've been asking, you know, my bank is reaching out to me saying it's time to apply for forgiveness. There's a couple things. One is I can't really give perfect advice because we've never been through this before. But what I've been telling my clients is, hey, if you can afford to hold off for a few weeks, if your bank isn't pressuring you, let's give the Congress a couple more weeks to kind of see what happens and if they're going to do this blanket forgiveness. And the challenge is, the reason I'm doing that is up front, and we've talked about this on a previous call with ECAR, is that I couldn't charge to help my clients with the loans in the beginning. And I wasn't going to anyways, but I was helping them with that. But it was only a one-page application. Now, the application for forgiveness, depending on whether it's the easy or the extended, we're talking, you know, 7 or 8 pages or 13 to 15 pages. And it's a service that I'm now going to have to charge for because it's a lot more labor intensive. But I don't want to charge clients if I don't have to. If there's going to be a blanket forgiveness, then I'm saying, hey, let's hold off and wait. So that's my advice. The facts, though, the banks are processing the applications and they're pushing them over to the SBA for forgiveness. The SBA has received 2%, what do I want to say? Of all the people who got PPP loans, they've received applications for 2% of those. However, they have not yet approved a single one. So they're not moving on them yet either. So you could apply for it just to sort of be first in line if that's going to be the way they process them. But either way, they're not doing any forgiveness right now. So on PPP, it's sort of a hurry up and wait right now. If you want to get it out of the way and get it into your bank, you can. Otherwise, I'm saying, hey, let's just hold off for a little bit and see if Congress comes together on something with that.
Do you have any idea when that's going to be back on the table? I just read something or other about another $1,200 stimulus check, but I didn't read anything about PPP.
So none of my statements I make are political. It doesn't matter to me either way. But what I'm going is based on what the president has said recently this week. He sort of called off, quote unquote, called off negotiations on a larger stimulus package. Obviously, he operates independent of Congress. Congress can do what they want. But that sort of put a stop to sort of a big package that was going to come together. But with that, he also tweeted out, I think it was yesterday, perhaps, that he's saying, hey, Nancy, if you send me something with $1,200 stimulus, I'm going to sign it and I want to get that money out to the Americans. So I'm pretty sure there is agreement across the board on the $1,200 per tax pay. I mean, there's again question about, you know, if you're married, you get, you know, $2,400 and how much are we doing for kids? But my point is, there's pretty much consensus on that. It's just whether or not they're willing to play along down there and start doing little bills to get things moving versus holding off to try to get one of these bigger comprehensive packages.
Do you remember, Greg, if that $1,200 check, the first one we got, was that taxable? I can't remember.
So no, it is not taxable. Okay. And the way it's working is I do have some folks that missed out on that. And there's a lot of people out there who, because if you hadn't filed a 2018 or 19 tax return, you were not going to get that, even if you qualified for it. However, it's not lost. And what I mean by that is when you file your tax return for 2020, which is what we'll do, you know, beginning in February to April, if you did qualify for that stimulus payment and you did not receive it, you will get that as a credit on your tax return. And by credit, I mean, say you happen to owe $3,200 and you were single and you qualified for the full $1,200, you would now owe, that would reduce you down to $2,000. And it looks like my Labradoodle has decided to join me by busting through the door. So give me a moment to close that.
This is what I love about 2020.
Yes, and so, and hopefully she'll remain quiet. So yeah, so it's not to be lost. I have some people that were upset that they missed out on it. It's not to be lost. Granted, that doesn't help you now, and I get it. And a lot of people have that cash crunch. I have to say, working in this industry, fortunately, knock on wood, 95% of my clients did. Some of them had their record year this year, right? Yeah. And you guys are all aware of the reasons there. And I do have a few that kind of used COVID as a convenient excuse to say, oh, you know, nothing's going on out there. It was more of, you know, somebody looking for an excuse to not, I don't even have to say do the work. I mean, you could have coasted through this year, really, and anybody who was doing the work did fantastic. So, although
not to minimize the COVID, the coronavirus, and the real fear about getting sick, there were some people that
so that small
really feared it.
And I have to say that I have some, and I guess where this goes back to is during the last recession, I had some people who took their foot off the gas too and blamed the recession. Not that the recession wasn't real, but the people who were willing to go out and do the work did very well. But yeah, and I do have a few clients who legitimately have autoimmune issues and things like that who just said, listen, I can't be out there this year. And you completely understand that it's absolutely legitimate, and I agree. I don't want to minimize that.
Now, what about the $200? The pandemic unemployment went from 600. Now it's I don't know if 200 is pandemic or just regular unemployment. Is all of that taxable? I don't know that either.
Yes, so that's a very good question. Yes, any of the unemployment programs are taxable. It's sort of in place of your wages. So, and granted, again, when I say wages in this industry, it's different because you don't receive a W-2, you know, with having a paycheck and having taxes withheld. However, if in the advice I gave before may become applicable again. The reason I say that is we don't know what this fall is going to look like in terms of this COVID. If flu season and cold season is going to sort of exacerbate this, and it's going to come back around, where people who may have not had to have applied for unemployment may have to apply for that unemployment again. And my advice there is that money is taxable. And if you do have the option to check a box when you apply to have them withhold taxes. And I would have that done, because if you can sort of afford to live on that check you're getting, and the reason being is you don't want that surprise tax bill next year, realizing that whatever amount of money you received in unemployment that you now owe the taxes on. So there is the option to have Connecticut and federal taxes withheld there. And on the subject of taxability, this is another question that has not been resolved. When the PPP loan came out, they basically said, when you get this loan, it's not taxable, right? And that is true. But when we sort of look at it practically, that's what the SBA said. And then the IRS came out and said, well, that's true that it's not taxable. However, whatever you spend that money on, you cannot take a deduction for that on your tax return. So in a roundabout way, it is going to be taxable. So some people have gotten pretty significant loans, and that's how it stands now. Again, there might be some clarification on this, but basically the IRS said, no, any income you get, the way this works is, and the way it's worked historically with other programs is, if you used $10,000, you got a $10,000 PPP, used $10,000 for payroll, your payroll expense on your tax return this year is going to be $10,000 less than what it actually was. You're not paying tax on the income, but you're losing a $10,000 deduction. So essentially, you're paying.
Okay.
But so essentially, bank on whatever amount of money you receive for the PPP loan. You're going to have to pay tax on that.
That's an interesting twist I hadn't heard.
Yes, and where it's sort of applicable in this industry is, as most of you may know, part of the tax you pay as an independent contractor is what's called self-employment tax. This is your Social Security and Medicare. Now, if you have a W-2 job now or in the past, on your paycheck, you're paying half of that 15.3% and your employer's paying half. Well, because we're all independent contractors, we're paying that full 15.3%. So what I don't know is if this money is going to be subject to self-employment tax also. So these are all things that I'm just trying to prepare clients to say.
Wasn't that tied to the advantage of forming an S Corp?
It is, yeah, absolutely. So the advantage of forming an S Corp, and this is a very common question, and we could spend a whole 8-hour day on S Corps and LLCs, but in a nutshell is an LLC alone does not save you taxes, right? If you form an LLC, there's arguably some level of legal protection, but no taxes. We then elect to be taxed in the IRS's eyes as an S Corp. And what we do there is, it basically says, instead of taking, let's say, just to use easy round numbers, you cleared $100,000, right? We had 150,000 gross commission income, 50,000 expenses, we netted 100,000. So on that 100,000, we would have to pay $15,300 in self-employment tax, which is Social Security and Medicare. Now, if we were to form an S corporation, the advantage is they say, listen, you have to pay yourself a reasonable salary, and on that salary, we're going to charge you the Social Security and Medicare, and on the remaining amount, you don't have to pay that self-employment tax. So the easy scenario is, okay, we pay ourselves $1,000 a week, call it $50,000 a year. So we're going to save about $7,500 because we'll pay the $7,500 on that $50,000 of salary, but the remaining $50,000 now. To take a step back, we get paid two ways. One is as the business owner and one is as an employee of the business. So we pay taxes on the employee of the business, but then on the ownership part of the business, we can, take out that additional $100,000 and save the the $7,500.
Now you gave nice round numbers on that example, but that would be something that an accountant like you would be giving the advice to the member, whether that number is actually a really good suggestion or higher or lower. Does it vary, or is that an actual realistic suggestion?
That scenario is a realistic scenario, the numbers, but it does vary for everybody. And it's that decision. So there's two main decision points. One is the issue of whether or not you have your broker's license. And in Connect, it's different from every state. I have a lot of people that go online to the different forums, Lab Code Agents and all these others, and they post their question. They say, they say I need to form an S Corp, right? But it's different by every state because, and here's why, and this just real quick, is in Connecticut, right, we can't pay a commission to an unlicensed individual or an entity, right? So you have to have a real estate license. So I can't just go out and form an LLC and say, hey, take my commissions that are due to me, Greg Antipoff, and just pay them over to this other company, right? Because that company's not licensed, right? So your broker could get in trouble for commissioning an unlicensed entity. However, in Connecticut, they say, well, if you have your broker's license, you can assign your broker's license to an LLC. You can't do it at the salesperson license level, so the typical agent can't do that. Something I'm looking to sort
That's
of
interesting.
to get the right people together at CAR and figure out, hey, can we put this forward? Because it's a win-win for the state too, because LLCs generate certain revenues for the Department of Revenue. And really, they're not losing any money. It's really a federal tax benefit you get by doing this. So there might be some interest to allow this to happen in Connecticut.
At the salesperson license, at the salesperson level?
Yeah, because it would open up a lot of my tax strategies to the general agents, where some of them are reserved if you have your broker's license and are able to have an LLC. An example, Rhode Island, you're allowed to assign your license to your individual license. There's individual rules. A lot of Florida is a big market, and a lot of people hear it out of there. Florida, you can assign your license to individual salesperson's license to an LLC. So it's different in every state. And so that's why you have to be careful about the advice you see people give online, because there's some intricacies. And even other accountants, I've had other accountants in Connecticut suggest this because it's a common strategy, but they don't realize that certain industries like ours or an insurance agent, there's these licensing rules that bump up against, there's these licensing rules that will dictate that. It's nothing the IRS says or Connecticut Department of Revenue. You could get in trouble with Department of Consumer Protection, who regulates our license, for paying an unlicensed entity. And my point is, I like to give strategies that are bulletproof. I don't want to say, hey, we can kind of do this. We might get away with it for a while, because it's just not worth it. Let's come up with a bulletproof strategy and move forward. And this might be something worth trying to fight for in Connecticut, because it can help a lot of people.
Wow, this is a great conversation so far. I have one more question before I open it up to the floor.
Sure.
At the beginning, you were talking about third quarter taxes, and if in case you needed to help your client, like form an S Corp at the tail end of the year. So my first thought was, well, how long does that take to actually accomplish? And,
Sure.
and tell me about
Yeah.
that.
It's a relatively quick process. And so to go back to answer your previous question before I move on to this, yes, this is something you want to consult with somebody on, because depending on what your numbers are, it may or may not make sense for you to do an S Corp for a number of other issues. And also, the reason being is there has to be sort of an income level where this makes sense, because there's additional administrative costs to having the S Corp, because you have to pay yourself a payroll, and because it's a separate legal entity from yourself, you really got to tighten up your books. It can't just kind of be like, yeah, I put everything in my personal account. You need a payroll service or a payroll subscription to do this. So there's a certain income level where it's like the savings has to outweigh the administrative cost of doing that. Okay, so now that we've decided that it makes sense to do that, what's the process? Okay,
Yeah.
So number one is we have to form an LLC. And why that makes sense now towards the end of the year is we have to form the LLC, and we can do that at any point. However, when we choose to elect to be an S corporation, we can only go as far back as when the LLC existed. So what I mean is, if I form an LLC now and say, okay, we're going to form it as of October 15th because I had a really big year this year and I want to be an S corporation. Well, the challenge is we can only take commissions that happen from October 15th to the end of the year, right? So it's not going to help us for this huge summer market we had. But however, if we form an LLC now, at least it'll be in existence for all of 2021. Even if you don't choose to elect to be an S corporation, as long as it's in effect, even if you come to me next October, November, whatever, we can then say, yeah, the LLC was in place. We can file what's called a late election and have that go all the way back to be effective January 1st, 2021. So the key is, let's just get the LLC in place, and then get it licensed so that my broker can cut the checks to Gregory Antipoff LLC instead of Gregory Antipoff individual, and then we can decide on the tax strategy later. And so in
Really?
terms of timing, you can work, I suggest working with a lawyer if you have a relationship, and a lot of people, you guys obviously have relationships with, attorneys who do your closings. And I've seen in most cases where, because you send them a lot of business, they will kind of, really give you a discount or help you out with forming that LLC. And I've done a number myself. You're talking a few minutes online if you know what you're doing. But again, there's a lot of, it's sort of those yes, no forks in the road where if you answer the question wrong, it can send you down a path, but it's not a difficult process and it can be instant. So you can do that instantly. And then once you have the LLC in place, we can file the paperwork to be an S corporation. Again, it's something a piece of paper we file. It takes 60 days to hear back on whether the IRS approves it. I've never had the IRS not approve it, but there is a chance for some reason, something other they may not. But either way, once we file that, we generally start to treat it as an S corporation. So this is something that can happen. I mean, if you came to me in the end of December and said, hey, we really need to do this, we can get it, it's something that we can get done. Your attorney can get done,
Is there a typical, jump off point in salary? Like if you're an agent who's making under 50,000, or if you're an agent making over 100,000, like at what point should an agent be thinking about this type of tax strategy?
If you're netting as low as 30,000, it might make sense. Generally about $50,000-$60,000 net is where it starts to make sense, because your savings at that point, say we pay you half of the 50,000, we're talking about maybe a $3,000 or $3,500 savings, and depending whether
that's worthwhile.
But my point is that's sort of the break even, because between whether you're going to do the books, sort of FSBO your books, like I like to say, or, and hire a payroll provider like Paychex ADP or somebody local, you're going to have about $200 to $300 a month in administrative costs associated with that. So that's sort of the break even. So, you just want to it has to make sense. If you're below that, it's going to end up costing you. And if you're above that, then it definitely makes sense to, for something to do. And outsourcing your books is never a bad idea. They need to get done. Yeah, well, my point is because there's a lot of sort of the sexy tax strategies that people hear about, and they want to say, oh, let me do an S corporation. But there's a lot of other strategies. And like a good pilot, without good instruments and good information coming at you, that pilot could never fly that Boeing plane, right? Doesn't matter how good they are. So for me, I can't advise you if you say, oh, I think I did this and I think my expenses are that. And, we got to have solid numbers because they really make a difference.
All right, let's shift over to Greg Hanner. He's got a question circling back to PPP for sole proprietors and the taxable element for owner compensation replacement. Greg, you want to embellish on that?
Yeah, it was just simple. You've got a lot of agents out there that are sole proprietors, and they were not necessarily the employer who had, business rent and other components that then you're saying were not going to be deductible. Mm-hmm. How does it work from the standpoint of if that agent, go back to your example of the 150,000 GCI, 50,000 expenses, 100,000. We knew that the PPP was, what was it, 21? What was the number? Or 20,003?
Yeah, I had everything. This is a whole binder on PPP, and I have my cheat sheet numbers on the front here. Yeah, $20,833 was the max.
Right, and then you had the owner compensation replacement component to that. Yes. Which was a factor of 2.5 times the.
Yeah. So if you took your 2.5 times your average monthly income at a max of 100,000, so roughly, if you were above that, take 100,000, divide it by 12, multiply it by 2.5. That's what gets to that max number of 20,000 and change.
And then that became owner compensation replacement.
Correct.
And then, so where is the taxable? You're still paying taxes on that straight up. But I'm sorry, on the PPP, So that's income. Where is the taxable component to that?
So this is one of the questions that remains. And it's a question I've had actually from the beginning. And here's why. So going back to the S Corp example, myself individually, I am an S Corp for my accounting business. So when I paid myself that money, I have to run it through payroll. And so it's going to show up on my W-2 at the end of the year. So I'm going to have to pay taxes as an individual on that income because it got paid out to myself, right? So therefore, the government is retrieving a portion of that through income tax, as well as my business. When I file my business return, obviously, from the sounds of it, whatever wages I paid myself, I'm not going to be able to deduct at the business level. Now, when to your question, as an individual, I'm not sure how this works because the government, there's no payroll where you're having those taxes withheld, where the government is going to retrieve that money back. Or likewise, if I had more employees or you have employees, you're doling all that money out and those individual employees are going to have to pay taxes on that money because it's part of their compensation. It's an unanswered question as the individuals to say, listen, we would like to, I mean, I'd like for it not to be taxable for everybody. That would be fantastic. But I'd have to think that it's going to be taxable because unlike having employees, there's no way the government is getting income taxes back on that. I assume that it's going to be taxable to you as an individual, the individual, not you necessarily, Greg, but whoever is using it as owner's compensation replacement.
Okay.
That was not over my head in any way.
I know there's a lot of new terms this year that have just never existed before. And I wish I had better answers, but because it's never been existed before, we don't have any sort of guidance on it.
And so the same thing initially before the PPP, became the thing that we focused on. EIDL was before that, and EIDL then went from 10 down to 1,000 based on number of employees. But again, keep the sole proprietor in mind. And most of our members would be sole proprietors.
Yeah.
That EIDL, the 1,000 that they got, you think will somehow be taxable.
So here's the interesting thing about this. If you took an EIDL by itself and you did not do the PPP and you operate by yourself, you would have gotten $1,000. If that's where you stopped, that as currently legislated, that would be $1,000 grant to you. You would not owe any tax on it, and you would not owe that money back. However, if you decided to go forward with also getting a PPP loan, as part of the PPP loan forgiveness on the application, it says, hey, did you receive an EIDL? And if you did, how much was it for? And basically, that amount becomes part of what you owe back. So if you didn't do a PPP, you would not have to pay the $1,000 back. Because you did the PPP, you will have, assuming you qualified for the full amount, you'll have $20,833 forgiven, and you're going to be stuck with a $1,000 loan to pay. It's silly, and I think it needs to be cleaned up because here's the other issue without getting too far in the weeds. If you went to Charter Oak and you got your loan, Charter Oak wants to have you have the full loan forgiven. They don't want to keep a 1% loan on their books. The interest they earn on it is not going to cover the administrative costs of mailing you the statement every month, right? But now, so they're going to say, hey, let's guide you and get this forgiven. But now we're stuck with us keeping $1,000 on our books that came from the SBA that now we have to manage this loan. The banks aren't going to be happy about that. Now they're going to manage a $1,000 loan at 1%. I don't know. It's one of those things that when you map it out, you're like, this just doesn't make any sense. However you look at it.
Yeah, and the whole concept of it being taxable is counterintuitive. Why not just make it untaxable and lower the number so that nobody had to do any accounting on it? You know what I mean? They made it very clear, from an income perspective, those higher waged family households or individuals, they were not getting the stimulus checks, period.
Correct.
So they got nothing. Right. And they probably also still had lots of liabilities. Correct. So you might say, well, geez, that person that made more money last year, well, they still could have been missed out on the, had their income dropped to nothing or been greatly reduced, but they got nothing. It's complicated.
It is very complicated. Well, and the thing is again, to use the word of the year, unprecedented. It's, the idea was, how can we get the money out to people the fastest? And it failed in that regard. Arguably, there could have been other ways to really just get the money out there quicker. The government thought, instead of trying to contact every individual, individuals have relationships with their employer. Let's get the money to the employer and they can get it out to their employees. But
it's not over yet, right? There's a possibility that some of this will be cleaned up and forgiven.
Yeah, I mean, if I were to say the better way to do it, I would have said, instead of trying to have people apply for it and use this 8-week window and all these other windows, is, as employers, we file quarterly returns that show how much wages we paid for the last quarter and how much payroll taxes. It would have been simpler to say, take whatever they filed for the first quarter and just distribute that back to the employer, because that's a quarter's worth of wages, and let it go that way without all of these funky equations and trying to track people down and getting the banks involved to try to underwrite these things. That's what I would have proposed.
All right, do we have any questions from our other guests? Deborah, Tisha, Brad, you guys are on, and I thank you for being on with us today. Greg is at your mercy. Got any questions for Greg?
Yeah, and I'm actually going to drop a link in the chat. And what this is, actually, if I can get the right one, I'll put it in there. I'm going to put 2 links in there. But one is, NAR actually released a video. It's about 13 or 14 minutes long. It actually walks you through the PPP loan application process. If you've,
is it still possible to apply?
No, I'm sorry if I misspoke. It's the walks you through the forgiveness application process. I do apologize if I said PPP application. So that link to the video I just put in the chat, and then all of the resources. NAR has actually been pretty good. I'm going to drop that link in here also. If you go to nar.realtor.com/coronavirus, they have this is where they've been releasing their resources associated with this. So part of communication I'm going to do to my clients after I get through the tax deadline of 10/15 next week is basically saying, hey, here's what is going on with forgiveness, all these unanswered questions, but NAR does have a video out there. It walks you through it if it is something you want to take on your own or at this time. They do walk you through it step by step. So that is a great resource that NAR put together.
Excellent.
Greg, there's one thing about the forgiveness topic that's interesting that I've heard some of the institutions and a lot of people are holding back on filing for the forgiveness because part of the current relief package that's being discussed is just making, if anybody got a PPP below 150,000, they're talking about making it forgivable and making a streamlined or fast-tracked application process. Yes, I got 150, and then making it forgivable just to make it
at the beginning. Mm-hmm.
Yeah, we did chat about that in the beginning, but it's worth repeating. And that's what I was advising a lot of my clients is, hey, listen, I don't want to do this service for you and have to charge you for it if I don't have to. Let's just wait and see if Congress does something here. And that's my hope too. I mean, I haven't been able to get to the things I really should have been doing for my clients throughout the year because of this extra burden of all this PPP and understanding all this stuff. I'm glad to do it and be a resource. But it's just extra work that even though I can charge for it, it's not something, there's no value there. So to have to charge somebody to do that, it's a bad use of my time and it's a bad use of your money. But if that's what it comes down to, then that's what we're gonna do.
We're gonna find out soon enough. Let me shift just a little bit, if you don't mind. You are our only affiliate who is a CPA, and so I would like to ask you a question. If I was a new ECAR member, a new realtor, a new affiliate for that matter, and I wanted to just set up my business, I need to get an accountant. What am I looking at for costs as an independent contractor? Are you able to give any sort of general information about what it costs to be a realtor and pay taxes, or use somebody to pay taxes?
Yeah, absolutely. So if I kind of look at it, and my business has evolved, right? As I learn, it's one of those things where there's a number of services you can offer because you're capable of doing them. And then you kind of look back and you say, well, what is it they really need? And am I doing a disservice by sort of offering certain things a la carte just to be a service provider? And so what I mean by that is tax return, generally speaking, probably if you were to go to any local accountant, you're looking probably between $300 and $600, depending on the size of the firm, what's involved with your, what else you have going on, right? Bookkeeping can vary, right? There's a lot of people are doing it many different ways, charging by the hour, fixed fee. There's a lot of online operations now. Where I kind of, so to take a step back, I don't like taking on tax-only clients. Not that I won't do it, but here's the reason. When you come to me after year end and I prepare your tax return, in sort of a morbid way, it's like me writing your obituary and you asking me to change the facts of your life. I can't. It is what it is at that point. Right. I can dress it up a little bit, but there's not a lot I can do. Whereas if we are working together throughout the year, and when I use that analogy of the instruments from the plane, we can make adjustments throughout the year where the fee you pay me is a small percentage of the savings that I can generate for you. So that's where when I say, listen, I start about $200 a month, but I will do your books for you. We will do tax projections. We will do tax planning. The tax return is included in that. But the point is that only makes sense if I'm able to, find more than that amount in savings for you, which I will do. Like I offer tax planning services. Now we're talking in the thousands of dollars. However, I offer a 5X guarantee, which means if I charge you $2,500 for a tax plan, I need to be finding you at least $12,000 or $13,000 a year in tax savings. And if I can't, I will reduce my fee down to the point where you are getting a 5X return on whatever you pay me in tax savings. And not just that, it's not just a one-time savings. Every year now that you have that plan, you're going to go forward and be able to recoup that. So I honestly say often I'm like, I'm literally selling money, and a lot of people don't want to do it, and I get it because there's sticker shock. But once you get through that first year, like there's huge dollars here. And I think part of the fact is people who are new to real estate, who have always had a W-2 before, tax time comes and they either use the software or they go to H&R Block or somewhere, which is perfectly okay. And they think we just enter a few numbers in the box and the tax return is what it is. And for a lot of W-2 people, it is. There's not a lot we can do. I can say, hey, you can increase your retirement a little bit, but that's it. But as a business owner, there's a lot of things we can do. So you can't just assume that, hey, my taxes are what they are. I don't want to do it. I'm going to wait till October 15th. No, there's savings to be had there. And there's a lot of strategies in this industry at every income level. And a lot of things from the Trump, Tax Act, where people who are on the higher level and want to invest in real estate, there's things that are available to realtors that aren't available to anybody else. So there's planning strategies all along the way.
Geez, it sounds like a no-brainer. Like just assume it as the cost of doing business, and you will excel much more than you ever thought you could just by going this route.
If you're open to the suggestion. Now there's some people who, you sort of do this and it becomes a cost and not an investment because they just don't want to do it and they're not going to change anyways. And at that point, I don't want to take your money and I don't want to work with you, only because my point is I want to grow together with you, right? So I'm not just like the service provider where I need to make sure I do X number of tax returns. Like I want to see you be successful. That's why I'm part of this organization. The more I can share and we can all, all ships rise with the rising sea. That's what I want to see for this industry, especially as we're challenged by the technology companies that are infringing on this industry. We got to figure out how to survive.
I did not know that you also did bill pay, like you do books.
Yes. Yeah.
So that's a real time saver for somebody who's an independent contractor and who's busy out there showing and selling properties. I know this because the association, when Mary Lee retired, we ended up, long story short, we now use a bill pay service. They service 50 real estate associations around the country, or I probably would have called you. In fact, I was going to call you until I found them. But the point is, it's saving us a lot of money and time and labor by offshoring our not offshoring, giving away our business.
The one sort of sales pitch I would give is, I think you should work with somebody. If it's me, great. If it's not, that's okay. But to your point, I only take on real estate clients. So I've streamlined the process to know what to look for in those books. And that's why, like, some people think I'm crazy. You know, for some people, when they hear start at $200, they're like, well, that's way out of my price range. And other people say, well, you're crazy. Well, but I've streamlined. I know when I see certain vendors, what those services are for, and I'm constantly building a service library as we see new vendors come into play. Oh yeah, that's a marketing thing, or that's something else. And my point is, that's how I'm able to deliver the value, because I have such a narrow focus. And when I read the tax law and everything else, I'm trying to figure out how to bring it to this community versus having a gas station and a lawyer and a landscaper and all these others.
It's a no-brainer.
So, and that's why I would say, if you chose somebody who works with associations, you're going to get a much better experience out of that than a local person or a distant person, because they're not in tune with the industry.
Yep.
So.
Okay, I'm going to shift one more time.
I have a question.
Yes, please.
So this is Debbie, and Susie, thank you for the segue talking about brand new agents. I am brand new, so I'm going to be very positive and say next year I'm going to have to hire you. Well, I'm really going to need your help. But this year it's all startup, so there are many more expenses than income coming in, which is fine. I expected that. Is there an official list of deductions that I can look at? I've seen lots of suggestions on that, but I don't want to take an internet suggestion.
Yeah, absolutely. So for a while, I kind of stole one. It's not the term. Inmin had a 5-page list of deductions. They haven't updated in a number of years. It was typically the one I shared with folks. I'm working on, it's one of those things on the to-do list, I never get to, but working on a more updated list, because there's been a lot of things that changed. But I will get the resource I have to either Catherine or Susie, and they can share it with you. The other thing is, and I've overpromised this before, I've done a presentation before called Smart from the Start, which is all the things that you need to be doing as sort of a brand new agent. And in fact, even seasoned agents aren't doing some of these things. I need to sort of record that so we can share it out. I haven't done that. But either way, I will share that, that worksheet as well. And really, so the number one thing, and it's not sexy, but it's my most common answer, is the best thing you could do to start: get a single bank account or a single credit card dedicated to your business and run everything through that. That way, even if you're not paying attention, if you're not doing QuickBooks, if you're not using me, at the end of the year, you only have 12 bank statements to go through, and everything in that statement is business one way or the other. Because the most common thing I see is people use their personal accounts, and at the end of the year, they miss a ton of stuff because they're going through and they're trying to figure out what was personal or business, and they're just missing a ton of things. And when you start talking about a 20% federal tax rate, 5% in Connecticut, and 15% self-employment tax, when you're paying 40% in taxes, missing $100 alone on some subscription you're losing $40 out of your pocket. So now extrapolate that over a bunch of things missed. It's real money. It's real money you're missing out on. The best thing I'd say is, and I get it too. Like, you have a mortgage to pay, right? You just got your first commission check. You got to go pay the mortgage. Just put it in that account and transfer it 30 seconds later, but at least everything will be in that one spot to start.
Actually, Greg, I think to that point, the new agents, you don't have any bad habits yet.
Correct.
And so when you started the conversation, you said, people sometimes will pay their taxes with the later commissions. When you think about it, depending on what you do in business, a minimum of a third of every check is gone.
Yes.
It's gone. And if you are a top producer, you're damn close to 50%.
Yes.
And so to that point, the other component is, if you transition from being a salaried employee, there's a new opportunity to you. And I'll let Greg, speak to it, but there's the SEP, and the SEP IRA. You're gonna, when you hear, okay, you owe X amount of dollars, and then Greg says, but wait, there's that opportunity where you can go and pay a little bit more to someone else called yourself, your future self, in your SEP. And what the secret sauce is, I'll let Greg do it in an accounting way, but my layman's way of explaining it is, if I want to go and if I have the ability to go and, let's say, put 3 or 5 or 10,000 into a SEP. Yes, I'm stroking a real check for take home, commissioned income. I'm writing a check for, let's just say 10,000, but it doesn't cost me the 10,000 because if I don't do it, I still have the tax liability of, let's say, 3,000 or 34,000. So if I can, if I get 10,000 in the future if I write a check for a SEP for 10,000, it's really only costing me, let's just say 6. And I like that return on investment. So Greg, take that idea.
Yeah. So a SEP is sort of one of the few magic wands I do have after year end. And so what a SEP is it's a simplified employee pension plan. Think of it as similar to if you've had an IRA in the past or a 401k. There's several different flavors of retirement accounts, and a SEP is one, and it's specifically designed in best case scenarios used for self-employed folks. Now, the reason the SEP is so attractive is because you can actually set it up after year end. So meaning when we go to do your 2020 tax, or actually take a step back, we still have a week left. You actually still have time to establish, if you were to come to me today and I had the time to prepare your taxes and I said, here's what your liability is, you owe $3,000, right? And I said, well, listen, if you contact your financial advisor, set up a SEP tomorrow, and we put $10,000 in there because you had a great year this year and you have the cash right now. If we put that $10,000 in there, we're going to save the $3,000 and essentially you won't have the tax liability.
Ooh, that is a good one.
So it's good because you can set it up after year end. Now, most other tax plan or retirement plans, they have to be funded by April 15th. The SEP, you have up until you filed your tax return, including up to the extension date. So it is something that now up to October 15th, if we haven't filed your tax return yet, you can still contribute to that account. So when I used the example before about now having the money to pay your taxes, I usually use that scenario for the SEP. And what I mean is in February, March, or April, we'll prepare a tax return. And I say, hey, Greg, you had a really great year last year. Here's where we're at. I said, if you put X amount in, you'll save this. We put a little more. I usually give 3 scenarios. So you can, it doesn't have to be one of those, but you get an idea of how much you'll save depending on how much you put in. You say, well, I don't have that money now, but it's the spring market and I have all these closings coming up in the summer. And I said, great, we'll put your tax return on extension. It's typically the only reason I like to put on extension. And when we get those closing checks, we now have the money. We'll fund your SEP for last year. We'll file your tax return. Everybody's happy.
What a good plan, since nobody's going to be spending that money on any vacation in the Bahamas.
Yeah, I mean, that's the thing. And so, but the other great thing too about the SEP and retirement in general is it's very common in this industry to in every industry, to kind of say, I'm going to push it off. I'll start a retirement account next year or whatever, right? Because we're playing catch up on debt or taxes or whatever, family vacations that we, I worked so hard last year, I deserve, a vacation. But, saving for retirement, is something that's very hard to play catch up on. So it's always a great option.
Okay, I do want to bring up, tell me if I'm wrong, first of all, is this year actually charitable deductions matter this year?
So they do, and I apologize for not having the exact figure, but my understanding is that there's going to be what's called an above the line deduction. I think it's either $300 or $500, where typically, fast forwarding prior to recent times, when you did what was called Schedule A, which is where you report your real estate taxes paid, a number of other things sort of get accumulated and you would get a deduction for those, including charitable contributions and interest paid on your mortgage, medical expenses. Well, they sort of, that was what's called itemizing. They then came out with a new higher standard deduction. They essentially doubled it. So if you're single, you now get $12,000. If you're married, 24.
Right, so it didn't matter anymore, really.
Yeah. So really, unless somebody was like brand new, and part of that is they also capped the tax part of it at $10,000. So in a lot of communities, not necessarily in southeastern Connecticut, although we have it, there's a lot of people paying $10,000 in real estate taxes alone. So they're hitting that max, but they could have been paying as a self-employed person, paying a lot in state taxes and other taxes that would really make that number big. So the only time I'm really seeing people get an advantage on the Schedule A is if they're fresh into a mortgage that's a pretty significant mortgage, meaning their interest in that first year, their $2,000 mortgage payment, the majority of it was interest. So now they have a $24,000 interest deduction. Now we add taxes and other things, and it's, you know, $30,000. So charitable contributions kind of got lost because people weren't making them. So now this year, because trying to encourage people to be charitable and a number of other things, my understanding is there's going to be a deduction that's outside of the Schedule A, $300 or $500, and you know everybody will be able to get that, regardless of income.
Perfect way to end this segment. And I would like to tell you guys about a couple of things that ECAR is doing, and one of them is our Halloween food drive, which is coming up Friday, October 23rd. It is in person in our parking lot. You can drop off food basically now till October 23rd. But if you come between 4:30 and 6:30, there will be somewhat of an outdoor party with a DJ, some wine and beer, and some pizza. So we can sort of gather socially responsibly and give food, and you can write that off. And because this year is COVID, and we do have that hopefully $300 to $500 extra deduction, we will not be having a live community benefit raffle, sadly, because we need to be safe about stuff. But there is still a big need, probably a bigger need than ever in the community. And so we will be asking our members, many of which you have had a fantastic year. So you may not get to go to a party and bid on stuff, but you certainly can give the amount that you might have spent that day at the community benefit raffle. And you can do that at ECAR through the We Cares Club that Greg Hanner, our president, established, which was meant to be a $5 deduction or donation for every transaction. But you can easily just write off, you know, $200 as a donation to the We Care Club. That goes into our charitable foundation, and that will be distributed much in the same way that the community benefit raffle donations would be made to those charities in our Eastern Connecticut who need it. So that's a great way to end our segment. Greg, this has been a fantastic hour with you. I'm so glad you're our affiliate. Thanks for everyone who came on the show. We'll get the links that you were talking about. Send me the stuff. I'll include it in the video that we publish to all of our members. So enjoy your day. Thanks again for coming on, and we'll talk again soon.
Sounds great. Thank you so much for having me.